Hello there, this is Chanel. Let's talk about managed funds. In simple terms, syndications. You have no idea what you're missing out on if you don't know about syndications, or in other words, managed funds.
Welcome to Cashflow Formula, insights into the world of investing, and learn how to build wealth through cashflow, simplifying the complicated world of alternative investments for you. If you like what you are hearing and want to learn more, consider subscribing to the show wherever you listen to it. Here's your host, Shanil Werasinke, founder of SNW Investments.
Before I go any further, I want to make it clear that this is not financial or legal advice. Please talk to your lawyer before you make any decisions. Alright, let's start then. Managed fund is a pool of funds which is raised through investors, and the managed fund can invest in different asset classes across many market sectors. I'm sure many of you are familiar with these types of managed funds. If not, that's fine. I'll go into more details how these managed funds are structured here in Australia. To give you a quick overview of the industry, or what we are talking here, let's see the latest numbers from ABS. Over the last quarter, June 2021, the industry expanded 5.1%, totaling to $4,310 billion of funds under management. Here's how I want to break this up for you. I'm going to start with two types of managed funds and why there are two types. And then I'll go into common structures in funds and the reasons behind them. Once we have those structures covered up, I'm going to explain to you overview of the compliance and the ASIC's duties. If you want to learn more about the taxation implications of managed funds, shoot me an email to info@cashflowformula.com.au or just shoot me a DM on any of the social media platform that we are on. I'll be sure to create an episode for that. Well, without any further ado, let's get into the episode. There are two types of managed funds out there: registered managed funds and unregistered managed funds. Obviously, the unregistered managed funds are easier and cheaper to set up. The requirement to be registered or not registered depends on the type of investors that fund manager allows to invest in that fund. If the fund manager plans only to raise capital through wholesale investors, then he is allowed to do that with an unregistered managed fund. However, on the flip side, if he wants to raise money from both wholesale and retail investors, then he needs to register the managed fund with ASIC. Let me quickly emphasize the differences between the types of investors. There are three types of investors here in Australia: retail, sophisticated, and professional investors. Retail investors are mom and pop investors. To be a sophisticated investor, you need to have any of the following. One being, you should have net assets of 2.5 million Australian dollars, or your income of the last 2 financial years should be at least $250,000, and that's in Australian dollars. Or you need to have control over at least $10 million of gross assets. Or you are capable of investing more than $500,000 in one offer. Well, that's the criteria for a sophisticated investor. Here's how you qualify as a professional investor. You need to control at least $10 million of assets, or you are an Australian financial services licensee, or a trustee for a super fund, and there are many more. In fact, there are many ways that you can qualify as a professional investor according to ASIC. I'm only going to highlight a few of them here in the podcast, but if you want to learn more about them, see the show notes. Well, either way, your accountant needs to verify these details for you. Alright, let's get back to what we were discussing before. So if the fund plans to raise money from retail investors as well, make sure to verify that in fact fund is actually registered with ASIC. If not, ask them why. You know what? Don't even worry about asking them, because that's most likely to be any scam you want to avoid. All right, now that we know what types of managed funds are out there, let's go deep into common structures that you may see when you are looking for managed funds to invest in. Most of the registered managed funds are trusts. Sometimes you may come across people use the structure of a company. However, this is not very common in the industry for many reasons. Mainly, ASIC regulations and reporting to them makes it a bit harder to raise capital as a company. On the other hand, unit trusts are not regulated as same way as those company structures. On top of this, tax advantages are also there when capital is raised through a unit trust. There's a difference between a unit trust and a managed investment scheme. Let's say you want to buy an investment property, but you don't have enough cash to buy that. So here's what you do instead. Find few friends who are willing to partner up with you to buy that same property. So now what you guys do is set up a trust for that single asset and syndicate money together and buy that property under the trust. So now the trust own the property and you and your mates are the beneficiaries. In other words, unit holders of that trust, which means all of you guys own the investment property. Okay. So that's how you form a single asset trust, which is different to managed investment schemes. Let me emphasize the difference between a unit trust and a managed investment scheme this way. In that unit trust you just formed with your mates, you guys have the direct control over the day-to-day operations. There are thousands of things that could go wrong when you are new to this game. Say, managing tenants, fixing their blocked toilet, or any other thing that is going on with their property. You name it. You need to deal with it. Here's how you can own the same investment property without having to deal with those annoying tenants. Now, what you do is find a good operator who has the experience in the industry and partner up with them. In this way, you just let them do what they're really good at. In the meantime, you get to enjoy the peace of mind not having to worry about the property since day-to-day tasks are handled by the operator. Well, as you can see, this is how we differ from that single unit trust and the managed investment scheme that you just invested in. In simple terms, you just don't have the control over the asset. And guys, this is how you really invest as a passive investor. All right, now let's get to the compliance side of the managed funds and ASIC's role here. ASIC is Australian Securities and Investment Commission. They are here to protect investors from getting scammed from illegal investment scheme. So to do this, ASIC has imposed certain rules and regulations over these types of managed funds. The first question you need to ask your fund manager is if the managed fund is offered through an AFSL. The common misconception out there is if all your investors are wholesale investors, then the fund don't need an AFSL. In my experience, this is not true. And this requirement does not rely on the type of investors you have. Well, if you only have wholesale investors, you don't need to register your fund with ASIC, which is a different requirement. This is about if your fund falls into quote unquote carrying on a financial services business. This is very important, guys. You need to understand this. This license is required if the fund activities falls into following three parts. Number one, operators' activities are motivated by profits. Well, this is reviewed by ASIC regardless of the percentage or amount you make in profits. That means even if you are losing money through the managed fund, ASIC still can say that you were motivated to generate profits, which could mean you are now need to accompany an AFSL with the fund. Number two, well, this one's a bit tricky. However, this is based to my knowledge. Look, guys, I'm not a financial advisor or an legal counsel for you. This is based to my knowledge, so you need to counsel with your attorney or an accountant, whoever that you need to deal with. You need to deal with them and make sure that you are in compliance with every single rule that ASIC has provided with us. All right, now that the disclaimers is over, I'm gonna get back to the episode discussion that we were doing before. If you are involved in systematic and repetitive activities, you once again are required to have an AFSL. Let me put this into simple terms for you. When a fund manager communicates to a potential investor about the fund, you are likely to be viewed as giving financial advice from the eyes of ASIC, which means now you are required to offer the fund through an AFSL. This is really, really important in terms of my point of view. Otherwise, you will be in non-compliance. And let's go to the third one. Fund manager is taking actions to start a business. What this means is that if the activities are taken in accord with setting up a business, well, the fund is again required to carry an AFSL. So to summarize this for you, yes, the managed fund is required to accompany AFSL. If a managed fund operates without one, may face the scrutiny of ASIC. You know what, guys? You don't want to mess with ASIC. Comply. Easy as that. You look after your investors. They've given you their hard-earned money. All right, now there's one more thing you as an investor need to look for. That is the product disclosure statement, also referred to as PDS, and the information memorandum, IM. This is a document your fund manager must prepare for you to make an informed decision whether to invest in the offering or not. Let's see the differences between IM and PDS. Fund manager does not need to lodge with ASIC, which means IM is not regulated by ASIC. Not only that, IM has no specific content requirement, unlike PDS. However, in a good IM, you should be able to find all the key financial information that you may come across in a PDS. So those are the key differences in an IM and a PDS. Well, a PDS mainly applicable where you are dealing with retail investors. So retail funds are required not only to be registered with ASIC, but also issue a PDS to their potential retail investors. However, there's one exemption to this requirement to provide a PDS to a retail investor. This rule is known as 2012 rule. To be eligible to this exemption, the AFSL licensee must be raising less than $2 million from less than 20 investors in a rolling 12-month period. I want you to get this properly because this is very important. This is how you go without creating a PDS for your fund if you are the operator. And for investors, you need to know about this stuff because when the operator communicates this to you, you need to know these exemptions that actually they exist. All right. If fund is capable of proving this to ASIC, then they are able to raise funds from retail investors and wholesale investors to an unregistered fund without worrying about the PDS. So the fund manager can put together an IM for investors. However, this exemption does not say that you can raise money without an AFSL. It is only there for the type of document that the fund manager has to prepare. To summarize this, if you're an investor, make sure that your fund manager is aware of these requirements and the fund itself is compliant with these regulations before you hand over your money to them. Well, if you're the fund manager, you should know about these. Please seek your securities attorney's advice. As mentioned before, this is not legal advice. Please speak to a qualified lawyer before you make a decision. All right, investors, this episode has been all about managed fund basics and what you need to know about them. In the next episode, I hope to walk you through different investment strategies for managed funds and hard questions you need to ask your fund manager before you handing them over your money.
Thanks for listening to the show. Remember to join us again next week for another episode. Learn more about what we discussed here by visiting our website cashflowformula.com.au. Until next time.